And if you look at the experience of the last 5 to 8 years, when we've got data for Bitcoin, Bitcoin acts like a monetary hedge. It proves itself very sensitive to changes in liquidity, and the scale of the movement up and down vis-a-vis liquidity makes it perform rather like exponential gold.
Hello everyone, and welcome back to another episode of The Pragmatic Investor. My guest today is Michael Howell, an independent investment advisor and a fellow Substack author. Today I had the pleasure of having Michael on to talk about global liquidity. Most of Michael's analysis focuses around this metric, but what is global liquidity? Why is it so important to markets? And how can we apply this in a practical and actionable way to our investments? Michael is perhaps the most knowledgeable person when it comes to talking about liquidity, a metric which has become increasingly important in the last few years. Expect to learn how global liquidity affects markets, what most people get wrong about liquidity and the business cycle, and how liquidity dynamics will affect the investment world over the next few decades. I'm really glad that I got a chance to have Michael on today because I've been following his work for some time, and I think that it's really interesting and he really hits the nail on the head on various issues. I think global liquidity is definitely one of the biggest factors moving markets today, and he is perhaps the person with the most knowledge on this subject. Of course, I highly recommend you check out Michael on Substack. He writes there under the name Capital Wars. He's also, of course, on Twitter. He provides institutional grade investment analysis at Cross-Border Capital, and you can also check out his book Capital Wars. If you enjoy this content, please go ahead and share, like, and subscribe wherever you're watching this. And as always, I hope you enjoy this conversation as much as I do. All right, Michael, thanks for coming on the show. I'm very excited to have you on today because, as a market analyst / pundit, a lot of what I do is basically look at squiggly lines on charts on the internet. Your squiggly lines I particularly like because they often talk about global liquidity, which is something that I've become increasingly interested in over the last few years. So let's just start with the simple question. What is global liquidity?
Okay, well, thanks, James. Great pleasure to be on your program. Let me define liquidity. I mean, liquidity really has two definitions, I suppose, in financial markets. One is probably the more widely known one, which is market liquidity, which is really a measure of the depth or ease of trading within financial markets. In other words, can you trade close to current prices in required size? That's one definition. That's market liquidity. But market liquidity stems from another concept, which is funding liquidity. Funding liquidity drives market liquidity, and funding liquidity is really a measure of the flows of money that are moving through world financial markets. We like to think of it as also a measure of the balance sheet capacity of credit providers, which is another way of thinking about it. But it's effectively money, put it another way, money in financial markets. It's probably a pretty straightforward definition. It's not money in the real economy, it's money in financial markets. Money in financial markets.
Okay, that's pretty straightforward definition and something on the surface quite simple to understand. And why is liquidity such an important factor when you look at markets then?
Well, simply that if you have money coming into a market, it will likely shift asset prices upwards. And unlike many other, let's say, goods markets or service markets, you tend to find that assets are inelastic. In other words, their supply doesn't change. So if you get a big pool of money hitting, or a big flow of money hitting an asset market, prices tend to go in one direction, which is upwards. And equally, if money leaves, asset prices tend to go down. So in the short term, there's very little supply effect. There's all about the flow of money. And therefore, money is what's really moving markets. And that's why we've invested a lot of time and effort into trying to understand this picture globally of how money is moving around the world economy.
Absolutely. It makes a lot of sense. And I think especially, and maybe you've made this point before, especially I would say in the last maybe 10, even 20 years, I think that you see that side of liquidity, that macro element, especially as we live in a much more connected world, markets a lot more connected, definitely driving maybe asset prices a lot more, a much bigger part of that equation. Now, how do you exactly calculate liquidity? Because, if I were to go online and search for something like Fed liquidity, they would have a formula which would be something like talking about the Fed balance sheet minus the TGA and the reverse repo. What is the kind of formula? How do you think about the makeup of liquidity?
Okay, well, let me just, before I answer that question, just pick up a point. You said that liquidity is a lot more important recently rather than maybe if you go back 20 or 30 years. I mean, it's fair to say that liquidity has always been around. It's not a new concept. I think the fact is that what you've got is you've got much bigger size of liquidity shifts going on now because the central banks are coming in. They're doubling, tripling, quadrupling their balance sheet sizes. So these are big shifts of liquidity into markets. Government deficits are bigger. So all these things are adding up. You've got China into the equation. China is a huge economy with a whopping great savings pool. That matters. So all these numbers are getting bigger, and the actual liquidity, and I'm here talking about the market liquidity of financial markets, is obviously a lot less because you've got you probably haven't got a lot of issuance. You've got holdings that are tied up. You think of the Mag 7 stocks, for example, in the US. How much of that is really a free float? A lot of the original entrepreneurs that started these businesses, Elon Musk, etc., are still sitting on very large shareholdings, which are not moving. So the free float of Western capital markets has shrunk, but the pool of money is bigger. So it matters much, much more.
Mm-hmm.
Now, to drill down to your second question, which is what is it we're really looking at? Fed liquidity is one of those concepts. I mean, that was something that has a long history. I mean, back when I was at Salomon Brothers, we used to look very closely at Fed liquidity numbers. And to sort of be precise about what this is, there's actually a definition we drew up back in about 2020 in a book called Capital Wars that I wrote. And we look in detail at what the Fed balance sheet's actually doing. But Fed liquidity is the liquidity creating part of the balance sheet. And the important thing to stress is that all items on the balance sheet don't drive liquidity or don't create liquidity. Some actually remove liquidity from the system. And so what you've got to drill down each of those line items and seeing how it affects the flow of liquidity in the markets. Now, Fed liquidity is likely to very strongly influence money market liquidity, and it will also show up ultimately in bank reserves. So Fed liquidity and bank reserves are more or less the same sort of number, and they tend to move very closely together, which was actually one of the points I think I made in the book Capital Wars. So that's what we're doing. How do we define Fed liquidity? We define it as total Fed credit, which is an asset side measure. As you said, less the Treasury General account, which is basically it's a pool of money that the US Treasury holds off the markets on the Federal Reserve balance sheet. So it's like a deposit account, but it's not circulating. And then other sort of esoteric elements like the losses the Fed is making in terms of its operations are a source of liquidity, plus the fact you've also got a detraction from things like the reverse repo facility, which is again another pool of money which is taken off or taken out of circulation. So all these things sort of add up or subtract to a figure called Fed liquidity. But it's not just the Fed that's important. You've also got to think about other central banks. As we've said, I think many times in different appearances on podcasts, is that Fed liquidity is important. PBoC liquidity, the People's Bank of China, is very important as well. And if I had to choose just two central banks, those would be the two that I'd watch. Other central banks, clearly play a role, but they're not really deciding factors. The ECB is important, the BOJ is important, the Bank of England, well, maybe a lot less important than it used to be, but it's there. And you've got to take those into account, which we do. But, if you had to choose two, it would clearly be the Fed and the PBoC. And there's another element that comes into this picture of global liquidity, because global liquidity is not just about central banks. It's also what the private sector does. In fact, the private sector is by far and away the biggest element. It's about 80% of the total. And private credit providers basically lend now increasingly on a base of collateral. So you've got to understand how collateral moves within the system. And by collateral, we're thinking about, maybe to take a homespun example, think of a home mortgage. If you're borrowing against your home is the collateral. But in financial markets, it tends to be financial assets. And the prime financial asset is a government bond. And the government bonds that tend to be used most are German bonds and US Treasury bonds. Those are sort of pristine collateral in many cases. So you've got to look at how those values are changing and also their underlying volatility. And one of the things that we look at very closely is the level of bond market volatility measured by something like the MOVE index, which is a measure of volatility across the term structure. And that gives us some idea about how effectively collateral is being used within the system or can be used.
Yeah, now correct me if I'm wrong, because I have heard you talk about this before. So just to kind of break it down, you would say that the three, let's say, most important parts of that kind of liquidity equation would be the Federal Reserve, of course, then the PBoC, and then the MOVE index, let's say.
Yeah, I would say those are the principal things. I mean, I could go on and extend that list. I'd say the dollar is important, but in many cases, the dollar is already taken into account by the Fed balance sheet. That will influence the dollar, but the dollar clearly comes in. The oil prices come into that. The tempo of the world economy comes into that. So there's a lot of other moving parts that you can think of. But if I had to choose three, I was on a desert island, and that's all I had. Those would be the three I'd look at.
Not that knowledge would come very handy in a desert island, but nonetheless.
Well, I may have a mobile phone and a dealer on the other end.
So obviously everyone knows what the Federal Reserve is, and people have an idea that there's the equivalent, which is the Central Bank of China, the PBoC. But can you dig a little bit more into what the MOVE index is exactly? Because I'm thinking that some of the listeners might not really understand what that means or what that is.
Well, the MOVE index is basically a weighted average of volatility at different bond tenors. So, for example, the 2-year, the 5-year, the 10-year tenors, those maturities, and the volatility at each point will differ. And what the MOVE index is an average across those different tenors. Now, the way that I tend to think of it is this is approximate, not exact. But the MOVE index currently is around 100. So if you knock off 10 from that, what you're talking about is average bond volatility of around 10% at an annualized rate. Okay, the MOVE index tends to average over the long term about 70, which is saying that bonds probably give you about 7% volatility on average on an annualized basis. At one stage in March of 2023, just after the SVB, Silicon Valley Bank collapse in the US, the MOVE index shot up to 200, which was a life-changing event in the fixed income markets. Normally, when my experience of being in a fixed income firm is that if you got anything over 150, people said that's end of life experience. Well, fixed income markets don't survive that. Well, actually, they did. They went up to 200. But it shows that these things can spike, and the MOVE index is much, much more important to the system than the VIX index. Which is stock market vol.
We'll get back to this conversation in just a minute, but first I wanted to talk to you guys about Seeking Alpha. As you know, I've been a contributor for some years now, and the first thing that attracted me to this platform was just the incredible amount of data and resources that it puts at your disposal. There's countless articles on most of the companies available in the US and abroad, tons of great investing ideas, loads of information on companies in terms of valuation, growth, profitability. You can find Wall Street estimates, earnings estimates, SEC filings, and it just makes investing so much easier. It's as simple as adding a stock ticker to your portfolio on Seeking Alpha, and you'll instantly be receiving emails and updates straight to your inbox with all the relevant information you need to stay up to date. You also have a stock screener, sector comparisons, and they even have their own Seeking Alpha quant rating, which you can access if you also subscribe to Alpha Picks. Personally, I use Seeking Alpha every day. I would feel lost without it, and I really think you could probably benefit from it too. If you'd like to check it out and try a 7-day free trial, you can do so in the link below. You'll also receive a discount. Now, let's get back to this conversation. Right, okay. Now, just to take things back into more the practical terms now a little bit, just to ground us a little bit, obviously I could ask you to explain the liquidity cycle back for the last 100 years. I'm not gonna do that, but more or less, let's say from 2020, obviously a big moment in markets there. Obviously we saw a big spike in liquidity led, obviously also a lot of fiscal stimulus. Arguably, would we say that would you then say that basically we had that big liquidity spike, then perhaps that liquidity bottomed out as the Fed was tightening in October of 22, I guess, and that now we're basically back on the up? Where are we right now? Where have we been in the last 5 years, and where are we in that liquidity cycle?
Well, I think the first thing to say is that, if we think of a liquidity cycle, and we're highly quantitative in terms of we're measuring these things, we're calibrating the numbers, we try and observe how these cycles move, and in our view, the cycle is about something between 5 and 6 years. Okay, that tends to be an average. Now, that's precisely wrong, but approximately right. You've got to think about the cycle probably bottoming in October of 2022, and by rights it should be peaking out sometime in late 2025. And that, at the moment, we're in the up stage of the cycle. The cycle has been, a little bit erratic in the last few months. It's been pushed up by many central banks easing. It's been pushed up by the fact that the move index has come down and credit providers have added liquidity. But it's been held back by the Fed, which initially pushed liquidity in, but has sat in its hands for a few months now. And the PBoC, which has actually gone into reverse after having injected a lot of liquidity early on in the cycle. It's now come back because the yuan has been weak. So we still think the cycle's moving up. All the evidence points that way. That would suggest to us that the world economy is in early cycle, not late cycle, and it would suggest to us that yield curves, which tend to follow the liquidity cycle, are in the process of steepening from where they are now. So that's the broad backdrop. Why is it a 5 to 6 year cycle? I think the way to rationalize that is to think back as to what's driving business cycles historically. And economic textbooks will tell you it's all about capital spending. You've got a capital spending cycle, which is about 9 to 10 years long. That's sort of the average life of a capital good. And therefore, you've got a replacement cycle every 9 to 10 years, which comes in and drives the economy. That makes perfect sense. And also, it makes sense to assume that that's driven to a large extent by interest rates. So interest rates can sort of attenuate the business cycle. And many people then therefore say, all we've got to look at is what the central bank is doing with the rate of interest. And that really tells us where we are in the cycle. I think that view is wrong on two counts. One is that, number one, fundamentally capital spending is not the main driver of world economies now, because capital spending is not really a key factor in terms of spending in most Western economies or even world economies. What you're finding is that where there is capital spending, a lot of it's coming out of China. That is not a decision which is made through the rate of interest. It's a state planning decision in many cases. In other words, it's the Chinese government which is really deciding a lot of those investment decisions. And therefore, it's not anything to do with the rate of interest. So the second point is that whereas textbooks would tell you it's all about interest rates and what central banks are doing with the rate of interest, it isn't. Actually, what we're in is a debt refinancing cycle. Something like 3 out of every $4 that are going through global financial markets now are refinancing trades. In other words, they're rolling over existing debts. We've got something like $350 trillion of debt in the world economy with an average life of 5 years, which tells you that $70 trillion has to be refinanced every year. That is an eye-wateringly large amount of money to refinance, debt to refinance. And what you need is balance sheet capacity to do that. And balance sheet capacity, in other words, what the financial sector can actually muster, is what we think about is in terms of liquidity. That's one measure of liquidity. Therefore, the debt refinancing cycle, which is basically, as I said, thinking about how that debt stock turns over, the average maturity of that, about 5 years, is what is really driving the cycle now. So the 5 to 6 year cycle in liquidity is a 5 to 6 year cycle in debt refinancing. And that is what is driving not just financial markets, but also the business cycle, because increasingly asset price movements are driving consumer spending. And that tends to be a mainstay, or lately a mainstay, of GDP growth.
Mm-hmm. Okay, interesting. So obviously, I think you make a very good point in that idea that obviously rolling over debt is basically, that's basically how things are done, right? Whether it be, companies today or governments around the world, that's basically, it's a perpetual debt cycle to an extent, right? So I guess my question my question would be then, but then you mentioned that there's that 3-5 year, let's say, debt wall, right? That you hit, but what exactly? But does that trigger anything though? Because that debt always gets rolled over, right? How is that actually, let's say, reducing the liquidity, so to speak?
Well, I mean, the point being is that what you need liquidity to roll over debt. And so if you look at the long-term relationship between debt and liquidity, it's been fairly stable. In other words, the ratio has been pretty constant. Now, you get fluctuations around that trend, but when you see debt, or when you see the liquidity to debt ratio, I should say, actually drop, that's when you tend to find you get financial crises. And most financial crises that you can think of in the last 20 or 30 years have actually been refinancing crises. They've reflected the inability of financial markets to actually roll over debt. There's been a shortage of liquidity in the system. Think of what happened in 2008. Think of what happened in the Asian crisis in '97. Think of what happened in the 2019 repo crisis in America. All these were crises where you had an inability to roll over debt, and they're basically refinancing crises. And it comes back to the fact that modern financial markets are not about new capital raising, they're about refinancing existing debt. It's a very different model. And things seem to go in reverse when you look at it that way. The world sometimes appears topsy-turvy.
Right, of course. Now, but to that extent, though, it seems like now, we have central banks very much on top of this idea, and obviously always very willing to basically expand, whether it be their balance sheets to kind of issue their fiscal policy. I mean, what do you think? Drilling back down into those main movers, maybe the Federal Reserve and the Central Bank of China, where do you think we are now in terms of policy? Also with the Federal Reserve, which I think obviously is a little bit more clear and obviously something that people follow a lot more. And then perhaps what do you think is happening with the Bank of China, and how is that going to affect the liquidity picture in the next few years?
Well, I think if we start with the PBoC, and let's think about the state of the Chinese economy and the role of the PBoC. The Chinese economy has found it very difficult to get restarted after the COVID lockdowns. I think that's fairly clear. The Chinese economy is very debt dependent. Latterly it has been, and therefore the role of the central bank, the People's Bank of China, is pretty critical in that whole equation. So the economy is living on credit, and that credit supply is largely dictated by the PBoC, either directly or indirectly via its influence on state-owned banks. So what is the PBoC doing right now? The answer to the question is the PBoC has basically been forced to tighten over recent months, certainly since the end of the Lunar New Year, because of weakness in the Chinese yuan. Now, that has been a corollary of a strong dollar, and it's also been a corollary of a weak yen. Excuse me. So that's putting a lot of pressure on the Chinese yuan. Now, as a result of that, the PBoC has been forced to take liquidity out of the system. And as it's taken liquidity out of the system, so you've had Chinese financial markets basically come down significantly. I mean, there's been radical underperformance, real estate is coming off, high street deflation, etc., etc. In fact, if you step back, what you can see is that China is suffering from an overvalued real exchange rate. And in what that really means is that China is suffering a capital exodus. Now, that may seem strange in the context that China has capital controls, but those capital controls are porous and money is still leaving. And as a result of that, the Chinese real exchange rate is going lower. And I think one of the questions that maybe people ought to ask is, if there were no capital controls in China, what would be the direction of capital flow? And I think almost certainly it would be significantly out of China. So the exchange rate's wrong. And the question is, how wrong can it be for how long before markets adjust? And what you're getting is that market adjustment now, where they're trying to push the nominal exchange rate lower. The PBoC are fighting that, and they're also alternatively trying to push high street prices and asset prices down. Now, the question is, the Chinese have got a choice. They can either keep fighting, or they can basically keep fighting and allow price deflation, or they can try and tackle the price deflation by actually devaluing the Chinese yuan. And that's ultimately what's going to happen, because China cannot go on in this current state of continual price deflation and asset price deflation. It's a recipe for disaster. We've seen that many times before historically. So ultimately, China has to ease, but it's a question of when, and that easing will correspond and coincide with a much weaker yuan currency.
Right, and I think we have, we have seen a bit of easing from China in the last few months, I believe. Where do we stand on the US? Because of course, everyone's been expecting that first Fed rate cut for quite some time. There's also been some talk of perhaps trimming down, quantitative tightening. Where do we stand on the Federal Reserve?
Well, I think just to be clear on China, au contraire, there hasn't been any easing by China. I think there's a lot of anticipation they'll be easing. They've taken a lot of liquidity out since the end of the Lunar New Year. But you're right to say that ahead of the Lunar New Year, from about the middle of 2023 until, let's say, January, February of this year, they did throw a lot of liquidity at the markets. That is absolutely clear. And that caused the markets to actually rebound upwards. And it caused the Chinese economy to sort of jolt higher. But since then, there actually been a tightening, and you can see that in sensitive commodity prices like iron ore, which have come down quite significantly since their early year peaks. Now, China, as I say, will have to ease soon, so watch this space. As regards the US Fed has been sitting on its hands somewhat. Curiously, why? I'm not sure why, but the fact is they have. They began the year by pushing a lot of liquidity back into financial markets, even despite their headline statement that they were quantitatively tightening. That's a somewhat misnomer because they're not. But they've been shrinking their balance sheet size. But as I said, the size of the balance sheet, not the critical metric in terms of understanding liquidity. It's the composition of the balance sheet you need to look at. And from the composition, we know that liquidity initially went into the system, but is now sort of flatlining. In actual fact, from middle of April, liquidity came down for the simple reason that the tax-paying season in the US pushed the Treasury General Account significantly higher. And the Treasury General Account is a subtraction from Fed liquidity because it's pulling money out of money markets and depositing it in a sterile or inactive account on the Fed balance sheet. Now, seasonally, what you would expect over the next 2 to 3 months is the Treasury General Account should drop by about $250 to $300 billion. That's the normal seasonal pattern. So we're looking for that. Not evident yet, but we're only at the end of June, so we'll see in the next few weeks probably the TGA come down and more liquidity come in, but that's probably not enough. What you've also got to see is probably more stimulus coming and a much more aggressive drop in the TGA, probably inspired by bigger Treasury spending. And that, I think, is one of the things to look at. There are other things the Treasury could do. It could start to implement a more aggressive program of Treasury bill sales. That is something they've tried before. That is not outside the realm of possibility. There are two observations in that. Number one, if they did that, you would probably see the reverse repo facility. Again, this is we're getting in the technical weeds here, but the reverse repo facility, another inactive account on the Fed balance sheet, would probably fall. So that would be more liquidity going into the system. And you might also see as well the banks buying up more of those treasury bills, which is technically a monetization of the deficit. So all these things are actually adding ultimately to broader credit growth in America.
Right. Now, I just wanted to go back to something you mentioned before. You mentioned that the Fed at the beginning of the year was actually injecting liquidity because of the fact that it was changing the makeup of its balance sheet. Do you mean because it was favoring treasury bills? What exactly did you mean by that?
Well, there were a number of things which went on. I mean, one was that there was something put in place after the SVB crisis, which was the Bank Term Funding Program. That pushed about 150 billion to the system. There was also some rundown in the TGA and a rundown in the reverse repo facility. The reverse repo facility fell quite aggressively because there was a big step up in bill issuance. And if there's a lot of bills in the system, money market funds will probably prefer to buy a treasury bill and actually hold money in a reverse repo account on the Fed's balance sheet, which is what transpired in that case. So what you saw was liquidity technically going into the system. We think the Fed has to keep an eye on liquidity levels because across the regional banks, liquidity is quite tight. And we saw with SVB that evidently one crisis occurred because of liquidity constraints on the banks, on the regional banks, and we think we're very close to those thresholds again. So it's entirely possible in the next few weeks or months that you could see a liquidity problem among a regional or some regional banks again. And after all, in America, there's lots of them still. It's not like the UK or other financial systems where you've got 3 or 4 major banks. In the US, you have a mass of thousands of regional banks. And that is a problem that the Fed has to address by keeping liquidity in the system up at high levels. And that's what we think they're going to have to do over the next few months. It would be unthinkable, as far as I can see, that Janet Yellen would oversee a regional banking crisis ahead of an election, a sensitive election as well. Right. So I think they're going to have to do that. The other consideration, of course, is what's happening to the real economy. And it's not simply looking at the US economy, but the world economy. And all the evidence that we see is that the world economy is slowing. It's not going into recession, but it's a sluggish period. And that may be a direct result of China and the fact that PBoC was forced to hit the brakes a bit. So you've got a slower world economy. The ripple effects from China are sort of rolling out, and that's slowing the US economy as well. We're starting to see that in the numbers in the latest PMI prints and some latest nowcast figures. GDP now, the Atlanta Fed and the New York Fed numbers are starting to come down for a flash GDP estimates. So it's suggesting that the Fed may be on the back foot slightly here and may have to cut rates as early as July. I mean, that was originally my prediction, that they'd cut rates from July. And it may, lo and behold, thinking I was going to be wrong for a long time, may actually turn out to be correct after all, by dint of luck more than anything else.
Mm-hmm. Right. So, I mean, correct me if I'm wrong, but the stage is kind of set for basically a somewhat of an increase in that global liquidity. The Federal Reserve probably will be forced to, China perhaps to an extent also. And I guess there's not much holding us back now, right? I guess where do we stand on inflation? That's kind of been tamed already. I mean, is there any reason for the Fed not to cut? I mean, are they afraid of anything at this point, or they're just, like you said, sitting on their?
I can't see why they're holding back. I mean, all the evidence, I think, suggests that they've got to cut rates. Mm-hmm. If you listen to the rhetoric that's coming out of other central banks, they're keen to ease, and some are actually doing that. Mm-hmm. I can't believe they would be making those noises without some guidance from the Fed, tacit guidance that the Fed was also thinking of cutting rates, because what you don't want is a lot of currency volatility in the world, and that's one of the things that central banks sort of hold against. So they don't want to create turmoil in currency markets. So why talk down your rates if you're not sure that the US is going to do the same? So I would tend to believe we're in the early stages of a rate cutting cycle. How much rates could be cut is a moot point. My answer would be a lot less than we're used to historically, for the simple reason you don't want to incentivize debt take up too much, because debt, after all, is the big problem that the world economy faces. So I think you're going to see very small rate cuts and very small rate increases going forward. There's going to be a lot more action on the size of balance sheets and liquidity.
Mm-hmm. When you say on the size of balance sheets, you mean like more direct purchases like QE, you mean?
Yeah. I mean, there simply has to be, for the simple reason that you've got whopping great deficits to finance, and the fiscal arithmetic is just been blown apart. I mean, people don't realize how bad this is. US government outlays are 40% higher than they were before COVID. They're not going down, they're only going up. And you've got on top of that faster trends in social security spending, Medicare, you've got the defense outlays, you've got Trump saying, he's going to promise X, Y, Z, you've got Biden saying he's going to promise ABC. I mean, these numbers are really adding up. Nobody is talking about tax increases after all. They're saying more spending, outlays are going to go up, they're going to skyrocket, and that's got to be funded. Now, the fact of the matter is the government always funds itself by definition, right? It does because it controls these numbers. And how does it fund itself? It can't do it from foreign buyers that much anymore because the Chinese are probably reluctant to buy a lot of dollar securities. The Japanese have got their own problems, etc. The rest of the world's not really big enough, doesn't have a big enough savings pool. And therefore, they're going to have to start thinking about funding it domestically. And they can do that in two ways. They can print money, which is probably the safest route, which is what I think they're going to end up doing most of the time. Or they can try and fund from the domestic private sector. But if you fund from the domestic private sector, you're going to have to pull money out of equities and other risk assets. And that would be negative for the economy because the economy is so sensitive now to wealth effects and consumer spending. So I think that to keep all these plates spinning in the air, they've got to start thinking seriously about monetization, whether you call that QE or not QE or quantitative support or some other acronym. I mean, the Fed's acronym department is going to be working overtime in the next few years.
Absolutely, and of course, we don't want all that to happen on an election year. Of course, they wouldn't want that at all. But it's interesting, and it's kind of drives me into my next point, which is kind of you always talk about global liquidity. A lot of people tend to talk about this stuff in terms of monetary stimulus and fiscal stimulus, right? And it seems, at least to an extent, that what you'd call maybe traditional monetary stimulus rate cuts probably be insignificant within the equation, and it's all a bit more geared now towards definitely fiscal stimulus, a big part of it, and then monetary stimulus. I mean, to the extent that they're monetizing the debt, I guess, but it's kind of a bit blurred. I don't know how you kind of divide between what you might call fiscal stimulus and monetary stimulus. I know a lot of people now talk about this idea of fiscal dominance, where everything's kind of a bit more geared towards that fiscal side. Some people are comparing it with the 1940s. Where do you stand on that? How do you?
I think you've sort of nailed it by saying there's a very thin line, or probably no distinction between fiscal and monetary policy. Because at the end of the day, the government doesn't create wealth. The government only takes wealth from the private sector. So the question is, how is it funding itself? And the fact is, if it's if I'm the government and I'm robbing you of your savings to spend it somewhere else, I can't see why that's a huge economic stimulus, because you're not going to spend and I am. So what's the difference really? At the end of the day, there may be marginal differences in terms of redistribution, but it's not really a way of creating wealth. What you've got to do is to think about the other side. Is how is it being financed from a monetary standpoint? And at the end of the day, governments are going to have to, think about, as you call it, fiscal dominance. But essentially, they're corralling the central banks to finance themselves, to finance them, and that is what's going on more and more. So, fiscal monetary policy are more or less the same thing in many cases. It just so happens that fiscal policy is used to channel credit into the bits the government wants it to be channeled into. Those are not necessarily the best bits, but they're the bits that it wants. They're the political decision. And that can have a stimulatory effect on the economy or not. Depends where they channel it, productive or unproductive assets. That's what's key.
Right, of course. Now, and if we zoom out a little bit more, then I guess, what is the end game here? Because as we know, obviously, we're basically stuck in this basically refinancing cycle. Obviously, deficits aren't going to shrink. Like you said, that there seems to be no will to shrink the deficits, but basically in this kind of monetary expansion, what's in store here? Basically, kind of a perpetual monetary inflation, devaluation. How do you see this playing out?
In a word, yes. And I think you're looking at a very different type of financial cycle, if you like, or whatever than we've been used to. And the way to think about it is, if you can maybe this is the best way to think about it. Sorry, if you think about financial crises, you've really got two forms. You've got crises of monetary deflation and crises of monetary inflation, and they're not really symmetric in the sense that a monetary inflationary crisis is really something that's caused by governments, and it's caused by governments effectively printing money. And what that tends to do is it undermines the productivity of the economy. It undermines the efficiency of financial markets. It tends to be a sort of bursting of balloons slowly. So what you tend to find is that air seeps out over years or decades, but it's a very unpleasant environment of sort of stagflation. It's not pretty. I mean, we've been down that road before, sadly, in the 1970s, and it didn't really end that well. But you get an awful lot of inefficiencies within the economic system. The other is a crisis of monetary deflation, and that tends to occur when the private sector is involved. And the private sector doesn't really create inflation, but if it creates too much debt, it can deflate suddenly if those debts are not paid back, and that's when you get like a sudden shock. Where asset prices plunge, whether it's real estate values or equity values or whatever, and that causes a major shudder in world economies. So I think you've got to think about these two crises differently. One is a very sudden crisis of monetary deflation, and the other is a very slow, escape of gas or whatever in a monetary inflation. They're both pretty bad, but the one that we're moving more towards is the monetary inflation crisis, which you can also depict as sort of politicians kicking the can down the road, which is what they're doing. It's an easy course for them, but it doesn't end well for economies, for employment or whatever else. And the people that tend to suffer during these stagflationary periods are really the less well off. These sort of so-called working classes of the world, for the simple reason that they're the ones that are dependent on for jobs, they need wage income, and they have to pay higher prices on things like food and staples, and they don't get the luxury of any offset through asset markets.
Right, exactly. The idea, right, that I guess asset prices would outpace the increase in wages, for example, right? Kind of increasing
some offset.
Right. Yeah. Increasing that divide. Yeah, that makes a lot of sense. And I really want to talk about, how this applies in terms of positioning and investing. Just one last question in terms of kind of the big picture, then zooming further out. Now, of course, for the last 30 years, people have been talking about the demise of the dollar. Where do you sit on this? Because it seems to me like, obviously, that doesn't seem to be exactly what's happening. If anything, the world is ever more dependent on dollars. It keeps kind of being there as a standard of value. Does that change at any point?
No, I can't see why it does. I mean, I've been a long-term dollar bull. I think that the dollar is very well underpinned. I think the irony in this whole thing is that the stronger or the larger the Chinese current account surplus, the stronger the dollar gets, and that's a paradox that needs to be understood and explained. And as far as I can see, that's largely because of two things. One is that China is effectively still a dollarized economy. So think of it as the state of California or whatever, or something like that. And China is, the more that China exports, the more its trade surplus grows, the more there is demand for dollars. Now you can quite rightly pick me up and say, well, okay, the problem is that looking forward, China is redenominating a lot of its trade in yuan. Well, that may be true, but the question is that what about those ultimate offshore holders of yuan? What are they doing with the yuan? Are they building up yuan balances, or are they switching it back into dollars immediately? And the answer is they're switching it back into dollars. So ultimately, China can't get off the dollar hook that easily. And we know that from an earlier statement, if you took away China's capital controls, there'd be a huge exodus of money out of the Chinese yuan, because probably the level of the yuan is wrong. So on that basis, the dollar still looks to be the major currency. And the other twist in the tail is that the more that China fears sanctions on its dollar holdings or its dollar assets, and the more that it channels those dollars outside of the US banking system and traditional vehicles, what happens is that the use of backwaters like Middle Eastern or Asian banks means that the recycling of dollars is less efficient in the world economy, which means that the elasticity of supply drops, which means that the dollar goes up because of supply issues. And that's what we're seeing right now.
Right, of course. And there's eventually kind of a shortage of dollars, so to speak.
Correct.
Right. So now let's get then to the interesting part in terms of positioning and how investors should think about this environment. Obviously, we're talking about perhaps an environment of monetary inflation. That means you probably want your traditional hedges. I've heard you talk about gold before. You've mentioned even cryptocurrencies, which I'm a big fan of, and my audience is very interested in. I'm very curious. How do you think about cryptocurrencies? Specifically, do you think about Bitcoin by itself? If you even think about it, Bitcoin, or do you actually think about Bitcoin and other cryptocurrencies?
Well, I mean, first of all, wealth warning, I'm not an expert on cryptocurrencies. But what I've said in the past is that if you look at monetary hedges, gold is the obvious long-term monetary hedge. That's what we've got the longest track record for. And if you look at the experience of the last 5 to 8 years, when we've got data for Bitcoin, Bitcoin acts like a monetary hedge. It proves itself very sensitive to changes in liquidity, and the scale of the movement up and down vis-a-vis liquidity makes it perform rather like exponential gold. So that's what I've stated. Bitcoin and gold, but particularly Bitcoin, are very good barometers of the liquid state of liquidity. And the very fact that Bitcoin is going down now is more or less telling you that liquidity conditions are not that favorable. But we are in an air pocket of liquidity through the second quarter of this year. We've been in one in the second quarter of this year, and seasonally liquidity we know is weak. I would be optimistic in the long term because I think liquidity is coming back, and I think that you need to hold a portfolio of gold and Bitcoin. And where you draw the line between Bitcoin and gold is really a sort of personal decision. I would draw it probably with more gold than Bitcoin. Others would have more Bitcoin than gold, but I say that's just a question of preference, risk preferences. I think you can also extend the ranges of monetary inflationary hedges to things like prime real estate. That tends to be historically pretty good. Large cap equities, big brand names tend to do very well because these companies have pricing power. And at least in an equity, you have some nominal exposure to inflation or rising revenue. So that's good. What you don't want is long dated bonds because they tend to do very badly in a monetary inflation. But you could think about quite seriously TIPS, Treasury inflation protected securities. And they're yielding about 2.25% in the US now, which is actually a fantastic long-term return. It's very, very difficult to get more than a 2% return out of financial assets in real terms in the long term. And therefore, if the government's promising to give you that, not a bad deal.
What about something like oil and energy then? Because obviously that did very well throughout a period like the 70s. Is it a bit different this time?
Well, it could be the same. It could be different. I think the thing is that what you're doing is you're raising more complexity into the equation. And I tend to think that commodities have two moving parts. One is a currency of denomination effect. So think of that as maybe the dollar gold price. And the other is a real exchange ratio, which is based on the business cycle. Think of that as the ratio of, say, oil to gold or copper to gold or a ratio like that. Now, those ratios, those real exchange ratios will actually move with the business cycle. So if you have a very strong business cycle, you would expect the oil gold ratio and the copper gold ratio to rise. Okay. Clearly supply factors will come into that. So if there's a big expansion in oil supply, that would dent that recovery in the ratio. If there's a shortage of supplies, we're told repeatedly is occurring in the copper market, you'd expect in the business cycle upswing that the copper gold ratio would move quite substantially higher. So if you look at those two factors and you throw in the currency of denomination, the gold price, you've effectively got, if you're earning copper, possibly oil, you've got a double whammy during business cycle uptrends because you've got the monetary inflation element going with you and you've got the business cycle effect on top. But you're going to get a downdraft in a business cycle downswing where your monetary inflation hedge is going to be damaged by a real economy slump. So there's more complexity, but by all means diversifying is not a bad thing.
Right. And I guess it applies a little bit to equities as well, right? Because you'd have a part of the equity, which is you're expecting the economy to be weaker, but because of the monetary inflation, you'd expect basically valuation multiples to basically expand. Would that be kind of correct?
Yeah, if you've got a rising liquidity environment, you would expect PE multiples to go up, absolutely.
Mhm.
And you're going to get that because basically the E is rising with the economy,
Mhm.
and the P is rising with the amount of liquidity in financial markets. And if as we're assured that the debt GDP ratio is rising over time because of the profligacy of government, certainly the public debt to GDP ratio is rising, let me say, you're likely to get a rising liquidity to GDP ratio simply because liquidity and debt have to move pari passu to avoid financial crises.
Mhm. Right. Yeah. No. Of course, that makes a lot of sense. And then finally, in terms of perhaps geographical allocation or forex, is the US the place to be, or at least dollar-denominated assets, since that is still and will foreseeably still be the reserve currency?
I think obviously from a starting point where the US market is now the dominant share of the MSCI, it's a tricky one to answer. But what I would say is that in my view, this cycle, it's been clear that US equities have become world equities. Okay.
Mhm.
In
Right.
a way that people are allocating to
Mhm.
US as their sort of global proxy. And I think that's the first time I've seen that in a financial cycle. So I think that's important. So I think that with that caveat, the answer is yes. I still think the US dollar is going to go up. If the US dollar goes up, or in other words, if capital flows into the US and the dollar goes up, that is a real exchange rate move, and that would also require US asset prices to rise. So I would be constructive on both the dollar and US asset prices. Yes, I think you want a large share in the US, but diversification is also a practical thing to think about. And I would therefore also think about holding equities, probably, well, certainly in Japan, because I think Japan is an interesting market to look at.
Mhm.
And then possibly on the basis that we were likely to see a slightly or some easing from the US, let's say, in the next few months, and a business cycle upturn, and China easing, emerging markets may be something to think about after all this time.
Absolutely, definitely, and definitely agree with those last points you made about emerging markets and Japan. Also, definitely interesting. And just to wrap up, of course, we can't finish, an interview in 2024 without talking a little bit about AI. Does that change the equation at all? I mean, when you talk about something like debt to GDP, is AI gonna come and save us, pulling up that part of the equation, and also to an extent more immediately, because obviously we've talked about the market rallying with liquidity, but do you see any signs of the market today or certain companies at least being overvalued because of AI, and that being an issue in the market today?
Well, I suppose I mean, okay. Number one is that we're not looking at individual companies, so it would be wrong for me to make those sort of judgments. They would be only misleading, I think. But I would say that if you look at the concentration of the US market, which is one of the things I think people are
Mhm.
focusing on as a result of AI,
Mhm.
um, these concentrations are not unusual in a period where there's lots of liquidity moving into markets because liquidity tends to gravitate into those popular areas. Now, you've got a fairly unusual feature going on in markets where um, you've got the Mag 7, which are dominating the indexes, but those are companies where the free float is actually quite narrow for the simple reason that a lot of the entrepreneurs that started these companies are still big holders of their equity.
Mhm.
So the free float is smaller than the market capitalization quoted. And the other thing is you've got a tremendous growth in things like 401k plans in the US and things that are called target age funds or target life funds, which are basically investing according to your demographic profile. So, in other words, younger people tend to hold more equities, older people tend to hold more fixed income. And so that moves or that inches year by year towards a different asset allocation. But basically, what it means is that many investors are effectively indexed now. So as money goes into those funds, they're chasing fairly fixed weightings, and that's what's causing a lot of these Mag 7 stocks to jump up. So it's not really necessarily only an AI phenomenon. It's a reflection of the narrowness of float in those markets against the backdrop of rising indexation, which again is a liquidity-based phenomenon. So I would say that. I think in terms of the supply effects of AI, I mean, frankly, in my view, we just don't know. Um, I mean, it could be positive, it could be negative. I mean, from experience, most of these big technology moves tend to be deflationary or disinflationary. We've seen that in terms of costs, and that has been something which has been a feature. Now, if you've got a disinflationary backdrop in the real economy, it does give the monetary authorities an extra degree of freedom in terms of their ability to create more monetary inflation without it being detected. So given the fact we know they've got to do that, it may be that they can keep pumping in money. High street inflation doesn't pick up, and you get this almighty asset boom over the medium term. That's what I'm hoping. And, there's no reason necessarily to argue against that on that basis. So I'm not an AI expert, but I think that the AI backdrop is probably going to be better rather than worse for financial assets.
Mm-hmm. Yeah, obviously, I'm not an AI expert, and oftentimes I find myself saying I don't know. That's oftentimes the best answer to a question, even if it's not what people always want to hear. And just to piggyback on what you were saying, it is interesting that you were talking about that move down in wealth from the generations. I was reading on a Bank of America report. I think it's about 86 trillion moving down to kind of younger generations, millennials. And like you say, that composition of how they invest, whether it be to equities, and obviously, according to recent surveys, a lot of that also could end up in cryptocurrency. So that's definitely an interesting trend. But Michael, I can't thank you enough for coming on and sharing your vast knowledge. Before we finish up, please let everyone know where they can find you on the internet, and obviously what they can expect to find there.
Yeah, there's probably the three routes in. We have a Substack blog which is called Capital Wars. That's a fairly regular or frequent blog where we do 2 or 3 pieces every week. A lot of it's data, also opinions, so that's available. We have a Twitter account for occasional tweets, which is called @CrossborderCap, which is the Twitter handle or the X handle. And there's our website for institutional research, which is crossbordercapital.com. So those are the 3 ways in.
Mm-hmm. Awesome. And of course, all the links will be down below. Once again, Michael, it's great having you on. I've been a big fan of your work for quite some time. So, look forward to keeping up with your work. And, I hope we can do this again sometime.
Great. Look forward to it. Thanks, James. Thank you.
Awesome. Thanks for coming on. If you're listening to this and you haven't yet subscribed to my newsletter, I highly recommend that you do. Every week I cover in-depth macro analysis, I do technical analysis on various stocks, and also provide in-depth stock reports. Paid members get access to my swing portfolio, my trade ideas, and also my stock portfolio and macro ETF portfolio. If you're interested, you can check out the link below. I'm on Substack at The Pragmatic Investor, and you can use the code podcast to receive a 30% discount now.